Good morning, everybody, and welcome to our next IFRS and corporate reporting webinar. I cannot believe it, but it's already the third one for 2023. And this month, we're looking at what does IFRS S1 mean for Australian organizations. Unfortunately, IFRS S1 has not been finalized yet, so we'll be looking at the ED for IFRS S1. Now, as always, I have with me Kevin Frohbus, who is our IFRS and corporate reporting partner in Sydney. So morning, Kevin.
Good morning, Aletta. As always, wonderful to see you. Glad to see we're so perky in Melbourne as we are in Sydney. And hello to everybody else.
I hope you're all doing well. Kevin, I had the privilege of going to a Victorian Chamber of Commerce event this morning at 7 a.m. And you won't believe it, it was all about ESG. So it was an amazing event. There were around 300 people in the room, but wonderful to hear from panelists and people who do some amazing work around sustainability and ESG. So I'm re-energized after that.
And interesting you say that, Aletta, because we were at a private equity event a couple of weeks ago here in Sydney, and sustainability is very much on the investors' radar. So it's more than just a buzzword now. It actually is becoming serious.
Absolutely. And you know, Kevin, what was interesting, we've always grappled with, so what's the difference between sustainability and ESG? And at BDO, we use it interchangeably. And we've always said, sustainability may be a bit more vague and ESG gives very specific meaning to it. This morning, I heard another take on that by the presenters, and they said, sustainability is a word that comes from the environmentalists. That's where the word originated from. And ESG is a word that originated from investors. And as you know, there's also corporate social responsibility, etc. But all of these words, they have an image on the screen where all of these concepts are at the bottom, but they all point upwards towards one goal, and that's the top of Everest, right? Or that was the image they had. Ultimately, it's one goal and the same goal. So it was interesting to hear that. And it's true, ESG is more investor term and sustainability may be more an environmental term, but they're now merging. We would like to begin by acknowledging the traditional owners of the land on which we meet today and pay our respects to elders, past, present, and emerging. And we extend that respect to Aboriginal and Torres Strait Islander peoples here today, on the webinar, and wherever we are and wherever you are, we pay respect to the traditional owners of that land. So as you know, this year, we've got two webinar series running side by side. And in this particular one that you're attending today, we're looking at IFRS and corporate reporting webinars. And we started off with looking at what's hot and what's not. And then we looked at how to incorporate sustainability and ESG information in your financial report last month. And today we're focusing on what we hoped to be a final IFRS S1, but it's still in ED's stage. All the discussions have been finalized, and they're now finalizing the drafting, and we're expecting it before the end of June, at the latest 30th of June. But you can see next month we'll look at IFRS S2, the climate-related disclosures, and then in May, as we always do, Kevin and I talk you through financial and sustainability reporting update, things to look out for 30 June financials. And then in June, we circle back and we focus on TCFD disclosures in a great amount of detail, because we know that is what's relevant for 30 June financials. But we also have a sustainability webinar series. And if you're onto sustainability ESG, you might have registered for these. We started off by looking at United Nations Sustainable Development Goals. We looked at the World Economic Forum, IBC, the disclosure requirements. In February, I think a really important webinar, if you've missed it, have a look, addressing your carbon footprint, the greenhouse gas protocol. How do you use that in order to come up with a baseline carbon footprint? And then last week, we looked at TCFD recommendations and the standards to be issued by the ISSB very shortly. So there's a great overlap between what we did last week and this week in IFRS. It's kind of where the two webinar series in a way collides because it's somewhat similar messaging. Then on the 12th of April, a lot of our clients are still saying to us, we, the finance team or the CFO, we think this is important. We realize we now have to look at this. However, you know, how do we get the board on site? We are doing a lot of presentations for boards, which we call activation or an activation strategy to convince boards that they should look at it and why they should look at it. So on the 12th of April, we're actually going to show you how we convince boards, help you a little bit with what a business case could look like, because absolutely sustainability reporting now more and more is the responsibility of the CFO and the finance team. And everywhere I go, and I'm going to a lot of events to either listen and learn from others or to present myself, the message is coming through. That sustainability experts are now being tapped on the shoulder by CFOs and CEOs and saying what you do is important. It has to come into our financial report. Tell us more. How does it link to the numbers? And it's really a hot topic. And then we look at the GRI standards in May and 14th of June. You know, if you want to do a sustainability report or include this information again in your 30 June 2023 financial report, you know, what could be approaches and how we could assist with that. So there's two webinar series, one looking at IFRS corporate reporting, the other one looking at sustainability or ESG, but they often cross paths because it's integrated reporting at the end of the day, and you cannot keep them completely separate. So today's agenda, only 5 parts. So there's the current status of sustainability reporting in Australia, just setting the scene, what are currently going on. Then we look at 30 June 2023 reporting. We want to give you a little bit of a heads up around 30 June 2023 reporting around the TCFD recommendations. We'll come back to that in June in greater detail and show you examples and practical aspects, but we just want to put it on your radar as a finance team, as a board member, as a CFO. So you know, Aletta, don't tell me about this June. I should have heard in March. So we're telling you in March. Then we'll look at the International Sustainability Standards Board, and you know, the 2 standards that we're hoping to see very soon. And then we'll look at the ED, the General Sustainability Related Disclosures, which will be the key focus today. And we'll end up with some next steps or key takeaways and things to focus on. So that's high level what we plan to do today. So current status of sustainability reporting in Australia. Now, I feel as if this will be a slide, Kevin, that we'll have in every webinar we do for the next 2-3 years, because the current status is changing more or less daily. So I think it's a good starting point to say, let's just remind each other where we're at the moment. Because if you look at the media, more or less every day, there's another aspect around ESG sustainability in the media. It's been talked about at conferences. Our regulator are quite active. We know Treasury is looking at it. The ISSB is looking at it. And the Auditing and Assurance Board are looking at coming up with guidance for assurance providers as well. So I want to start with ASIC. Now, ASIC is incredibly important for people attending this webinar, because most people attending this webinar would be associated with an entity that prepare and lodge general purpose financial statements with ASIC. And therefore, it's important to know what ASIC is looking at. And ASIC, when they looked at their focus areas for 31 December 2022 reporting, they said, and this is an extract, climate change risk could have a material impact on future prospects of entities. Directors may also consider whether disclose information that would be relevant under the TCFD. And then also saying at the bottom that TCFD recommendation recommendations will help position companies for any future reporting under standards being developed by the International Sustainability Standards Board. So really what they're saying is we currently have TCFD recommendations. It's the only thing that's been finalized, approved, so please look at that. And that will put you in a very good position to ultimately transition from TCFD recommendations to the imminent IFRS S1 and S2. So ASIC is already flagging that. So that was on the 1st of December last year. And I've got a link to all these releases if you want to read the whole thing to get the context. But then ASIC went further on the 7th of December, so nearly a week later, and they outlined their expectations on sustainability-related disclosures. So TCFD recommendations are the task force for climate-related financial disclosures, and they're saying, yes, use TCFD, and it will put you in good stead to prepare. However, don't forget about all the other sustainability-related disclosures. And therefore, they're saying, you know, again, you should be aware that ASIC continues to encourage listed companies, but also other entities where these risks are significant or material, to use the TCFD recommendations as a primary framework. In doing so, you will be well placed to transition to IFRS S1 and S2. And then they all say the ISSB progresses with its proposals and other related developments. They evolve, and directors will need to carefully consider what kind of governance structures might be required to be developed now in order to best support company disclosures and reporting in the future, having regard to the likely deeper connection between sustainability reporting and financial reporting. And I love that. A likely deeper connection between sustainability reporting and financial reporting. They're really flagging that old terminology, integrated reporting. And we'll see that throughout today's presentation. So ASIC is really out there quite strong around sustainability and TCFD recommendations as well. We also know that the ASX in the 4th edition of Corporate Governance Principles and Recommendations make reference to the TCFD recommendations, and also the ASX Principles and Recommendations also require a company to disclose material exposure to economic, environment, and social sustainability risks, and how the entity manages or intends to manage those risks. So again, yes, we recommend TCFD. However, we acknowledge that there are broader risks around sustainability ESG that could be material or significant to your business, and therefore you have to disclose those. So don't stop with TCFD. There are other risks as well, and ASX acknowledges that. Then APRA does a similar thing in that they say in their Prudential Practice Guide, CPG 229, they talk about climate change financial risks, but they also say, while not mandatory, CPG 229 aims to assist APRA-regulated institutions in complying with prudential standards, and then they list a few standards that you would find interesting. Risk management standards, government standards. So I think, again, saying don't stop with TCFD, don't stop with climate-related financial risk, but think broader around ESG and sustainability-related risks. And then obviously we've talked about this on a number of occasions, the Treasury consultation paper that came out in December 2022. And in that paper, I've just got a small extract. Again, they say we're going to align in Australia. It's our intention to align with TCFD recommendations, and also once the ISSB issue their standards to align with those, acknowledging that IFRS S2 is based on and an extension of the TCFD recommendations. So currently everybody talking about TCFD recommendations, but remember those will be replaced by IFRS S2. So that's a little bit of the current position.
Sorry, I wonder if I could just make a comment at that point, because I think you're right. The section you just did, we're going to keep repeating that as we do more and more webinars. But for those of you who are listening to Aletta and have gone through all those, I feel like the key takeaway for me when you were laying all those various publications out is that they are mostly or largely an indication of where the regulators are going, and it's not often you get documents released by regulators that essentially put a roadmap in front of you of where they're going. You know, often regulation comes out and you just have to comply. This is a gift in a way for organizations to really start to see where the regulators at a minimum are moving, because everything is going to follow from that. And I think if you have to take one takeaway from it, is it's a risk management issue and it's a governance issue, perhaps in the first instance. So if there's nowhere else to start but to think about it as a risk issue, then that's where you should start, a governance issue, and start to actually see this as a roadmap for where the regulators at least are moving towards. That was probably my takeaway from that section, Aletta.
Kevin, that's a really good point, that regulators are giving us a very good idea of what their thinking is, and we know they're following what has happened in other countries and other regulators, what they're doing there. So, I mean, I think it's a great point. The other thing is we have seen, and I think I've been quoted in the press last week to say that the top end of town have been doing sustainability reporting and all of this for a number of years, and amazing stuff. And, you know, even they who've been doing sustainability work are now grappling, but we have to report it. And it's no longer voluntary what we're doing, it's going to become mandatory. And when it becomes mandatory, it's not just mandatory to report, it's going to be mandatory on exactly what to report. All right, so even the top end of town are thinking, oh, this reporting is difficult, but the top end of town have often done this on a voluntary basis, so they've done great work. What we're seeing is in the supply chain of the top end of town, or with smaller and medium-sized entities, this mandatory reporting is really putting a focus on sustainability. You know, and we know this is coming, so there's a real need to consider this. We know it's coming, we can't avoid it anymore, it's no longer voluntary, and it's a game changer in a way for SMEs. If we look at the next section, which is focused on 30 June 2022 reporting and putting a spotlight on these TCFD recommendations, and we're doing this well in advance because we want to give boards, CFOs, finance teams, who are the majority of the people who attend our webinars every month, a heads up on what do we mean by this, and there's a bit of work involved. So you can look at the TCFD recommendations, I've got the link there, but key features of these recommendations is it is adoptable by all organizations. Their idea is that it should be included in financial filings, which is a US terminology, but included in broader financial reports being lodged with the ASX and ASIC. That's the intention. That's where they would like to see it. It is designed to solicit decision-useful, forward-looking information on financial impacts. And there's a strong focus on, as Kevin outlined, risks and opportunities. And in particular for the TCFDs, because it's focused on climate change, the focus is on transitioning to a lower carbon economy. And we're seeing in Australia, there's now also a focus on transitioning to a lower carbon economy. And we know government's got the safeguard mechanism in place, etc. And the way they articulated in the TCFD recommendations is, you know, there are a number of transition risks and physical risks. There are a number of opportunities as well. And all of these risks, all these opportunities impact your strategic planning, impact your risk management, and ultimately flow through into a financial impact. So it impacts revenue and expenses in your P&L. it impacts cash flow. It impacts your balance sheet, and it impacts your balance sheet because it has an impact on the value of assets. It has an impact on liabilities because maybe we have to book additional liabilities. It has an impact on the ability to raise capital and finance and the cost of that capital and finance. So this figure pulls it all nicely together, but a great discussion on how these transition risks and physical risks really has a direct impact on those financial statements. And that's why finance teams, CFOs, have to be very aware of all these risks and how they impact. And the core elements of these TCFD recommendations are around governance in the first instance. So what's your governance around climate-related risks and opportunities? And then they go, okay, now that you've got the governance in place, on a strategic level, what are the actual and the potential impacts of these climate-related risks and opportunities on your business, your strategy, your planning? And then it goes down to risk management. Now that we've identified the risk, what are the processes that the organizer uses to identify, to assess, and manage these risks? And then finally, when we get to metrics and targets, what are the metrics and targets used to assess and manage these climate-related risks and opportunities? So I think a lot of people are quite fearful and say, we need targets. Targets is the last thing you need, right? The first step is you need governance, and then you need strategy, and then you need risk management. And if appropriate, and if supported by all the work you've done, you could come up with metrics and targets. So a lot of the cases or potential cases of greenwashing, and that's out in the media, is where organizations maybe jumped to metrics and targets too fast before they've got all the other things in place. So I would say be very careful before you put a metric and a target out. Make sure you can substantiate it and you've done the work on how do you get to that metric, how do you get to that target, and is it realistic, is it achievable? If we look at these TCFD recommendations, believe it or not, there are only 11 recommendations. But this is only a start to what you're ultimately going to see in IFRS S1 and S2. So this is a good starting point because we're only looking at 11 recommendations. And these 11 recommendations sit across the 4 pillars around governance, strategy, risk management, metrics, and targets. And look at how soft the words are. And when you look at governance, it says describe the board's oversight of climate-related risks and opportunities. And then it says in the second recommendation, describe management's role in assessing and managing climate-related risks and opportunities. So there's 2 items under governance, really. What's the role of your board and what's the role of management around, and that's the governance, around climate-related risks and opportunities, and you have to describe it. And then when you go over to your strategy, again, you use the word describe the risk we've identified, describe the impact on the organization's business strategy and financial planning. So this could be wordy disclosures, and then describe the resilience of the organization. So although we've got all these risks, potential risk for our business, how resilient are we? How can we deal with it? How are we well placed to deal with this? What have we already done or already have in place to deal with this? And if you go to risk management, describe your processes to identify risks. And I think here with risk management, a lot of great things already happen at organizational level around risk management. So it's more when you look at your risk appetite, when you look at your risk register, you look at how you assess risk in your risk register, the likelihood, the potential impact, the controls to mitigate, all those things. In that risk register, have you considered whether climate risk or any other sustainability risk should be part of your broader risk register? Because to manage sustainability and ESG risk on the side doesn't seem to make sense. It should be embedded in your overall risk management approach. And then when we go to metrics and targets, disclose the metrics used by the organization. And then it gets a little bit more prescriptive in that it says disclose scope 1, 2, and 3 if a greenhouse gas emissions and the related risks. So as you've seen in the webinar on scope 1, 2, and 3 in February, that's not as easy. And it says describe the targets. So here it's becoming a bit more specific around scope 1, 2, and 3. But the language are still quite soft. It's describe scope 1 or disclose scope 1 and 2. And if appropriate, scope 3. So it's not really mandating or going too hard on scope 3. And we know for most entities, scope 3 is the biggest part of their carbon footprint. They also say the principles for effective disclosures. You should represent relevant information. It should be specific and complete. It should be clear. It should be balanced, understandable, so no greenwashing. It should be consistent over time. It should be comparable among companies within a sector, an industry, a portfolio. It should be reliable, verifiable, and objective. And number 6 is where our assurance and audit providers come into play. If you come up with these disclosures, these TCFD recommendations, can you stand behind it? If you've got targets and metrics out there, or disclosures around your governance, can you prove that that's what you've done? So that's important, and it should be provided on a timely basis. So these are the broad recommendations or the principles for these disclosures. I just want to take a moment to zoom in on the metrics and targets, and in particular the second one there, disclose scope 1 and scope 2, and if appropriate, scope 3 greenhouse gas emissions and the related risks. This diagram is the one we've used in our February ESG webinar on how do you determine your carbon footprint. And as you can see, this is a complex thing. Your scope 1 emissions on the sites that you control. Scope 2 is outside your control, other sites in your supply chain. Scope 2 is actually just looking at purchased electricity, and scope 3 is the rest of the indirect emissions. And it's downstream and it's upstream, and this is complex and this is difficult. So to do this measurement under the greenhouse gas protocol is one of the recommendations out of the TCFD. To do this is not easy. You need data, you need a process, you potentially need assistance to do it. But really important to acknowledge that this is already one of the TCFD recommendations. And I think many organizations, when we speak to SMEs, have not looked at this, haven't come up with a baseline, and therefore they cannot come up with metrics or targets because they don't have a baseline. And just my final point on this, and this is, if the big end of town have a carbon footprint and they want to reduce that carbon footprint, and I know this is the case, the biggest part of their carbon footprint is scope 3, they will look down their supply chain and expect their suppliers to reduce their carbon emissions because they've got no other way to reduce their scope 3 carbon footprint. And so that is coming down the supply chain. If you want to continue to provide services to, let's call it, the big end of town, you'll have to make sure that you've got this data available, that is verifiable, and that you can prove what you're doing around the carbon emissions and a decarbonization strategy. Absolutely, this is critically important. So it's not just the mandatory requirements coming. It's not just that you currently have to do it under the TCFD recommendations and ASIC expects it. It's actually good for business because it helps you to continue to provide your goods and services to those organizations who have to do mandatory reporting, who are already following the TCFD recommendations. Also want to say, we've touched on TCFD recommendations briefly today. We'll circle back in June in this IFRS webinar series. We did discuss a lot more detail last week in an ESG webinar, but we also have online learning. So this is free on our website. You can do some free training on the TCFD recommendations. It's around an hour to an hour and a half to work through it. I've recently redone it because I wanted to make sure that it's relevant and it doesn't need a little bit of an update, but still a good course to work through. I've done it a weekend or so ago. So I would say 60 to 90 minutes. If we move on, Kevin, I'll pause there if you wanted to add maybe something on the TCFD recommendations.
No, I think Aletta, it just reiterated the point before, and I think in my mind, if breaking it down for the audience who haven't started or looking at this beast in front of them, coming back to governance, risk, roadmap, are really some of the themes. It's not specifically focusing on climate, but clearly that's big out of the TCF. Just going back to governance, roadmap, start somewhere,
Yeah.
start early.
Correct. If we now move on to the International Sustainability Standards Board, the ISSB, the sibling to the International Accounting Standards Board, we know the ISSB is working really hard to bring the ISSB standards, the TCFDs, the GRI, all into the IFRS standards, so the IFRS Sustainability Disclosure Standards. And once you see IFRS S2, you can see that these TCFD disclosures have been included and expanded on within IFRS S2. So that's what they're trying to do, get to one set of rules for information to be included in financial reports. So this is the other thing. Often people talk about sustainability reporting, and they're thinking that sustainability report that's talking about their sustainable development goals under the United Nations, or they think it's a separate sustainability report under the World Economic Forum. Be very clear, when we talk about sustainability information here and sustainability reports, we're talking about that information and reports that is part of the financial report. And there's an expectation that there's a relationship and a link and an integration with this information, with that in the financial statements. So there's a very specific focus. The two EDs, and we're expecting the standards before end of June, IFRS S1, general requirements for disclosure of sustainability-related financial information, but also IFRS S2, looking at climate-related disclosures. So let's look at IFRS S1, the general sustainability-related disclosures. First of all, finance people would be aware that if we look at IAS 1, which is presentation of financial statements and talk about a complete set of financials, and if we look at IAS 8, which is accounting policies, changes in accounting estimates and errors, those two standards really are the foundation of the establishment and the implementation of accounting policies at an organizational level. So what the ED IFRS 1 S1 is designed to do is to be a sustainability equivalent to those. So they want to talk about a complete set of sustainability related financial disclosures. What would that look like? And they say this complete set of sustainability related financial disclosures presents fairly sustainability related risks and opportunities to which a company is exposed, and it's relevant to their enterprise value. And they also say guidance is provided to enable reporting by a company on all significant sustainability related risks and opportunities. So what you'll see in the appendix to IFRS S1 and the appendix, especially IFRS S2, there's a lot of potential guidance on what this would look like for different industries. And that is where the existing ISSB standards come into play. They picked up a lot of that wonderful industry disclosures and put it as guidance into IFRS S2. So if I'm in a particular industry, I read IFRS S2 and I think, okay, how do I make it real for my industry? You can look at the guidance in the appendix. So important that IFRS S1 is trying to establish, as a foundation, similar to what IS1 and IS8 does for financial statements. They talk about all sustainability-related risks and opportunities, and to present fairly all those risks and opportunities. So it brings us back to one of the slides we often talk about, and that is, what is part of ESG and sustainability? And you can see climate change is just one of the environmental aspects. And there's 24 factors here, and climate change is just one. Yes, we're starting with climate change, IFRS S2, but IFRS S1 is actually saying everything on this slide is fair game and should be considered, and obviously add more, because this is not an exhaustive list. But all of this is relevant, and organizations have to, as soon as possible, assess and reach out to stakeholders. What of this is important to our stakeholders? But you have to overlay it with what your business can potentially impact. Because no good to say all my stakeholders care about biodiversity, but as a business, we cannot move the dial on biodiversity, because that's not the nature of our business. So you have to look at what our stakeholders saying, but also what you can do. And that would determine what would be a significant risk and a significant opportunity for your business. I heard two examples at the breakfast this morning, Kevin, that made me think. The one was around Patagonia, and we know they do a lot of work in this space. And they, the focus that they've got as a business is on climate change. But if you think about it, it makes sense, because they prepare and sell and create gear that are used by people who are skiing, used by people who are out in nature, walking, hiking, all kinds of environmental, let's say, activities. Though for them to have a significant risk and opportunity around climate change, resonates with their stakeholders, because if we have climate change and maybe we can't ski, or maybe we won't have the environment to enjoy for our hiking trips, etc. So there's an alignment. Another example that they mentioned there is, if you've got a publisher, if a publisher says, so what would be a sustainability related risk and opportunity and something that's important for our stakeholders, I think literacy and improving literacy and quality education makes sense. So one of the people who spoke there, her publisher, she's written a book, her publisher supports literacy and education. And again, it aligns to your core purpose. And, we've previously talked about it at BDO as accountants and auditors, for us to make potentially, our stakeholders care obviously about financial matters, but for us to focus on financial education and financial literacy in the broader community, I think is a beautiful alignment potentially for our business. So if you look about ESG and sustainability, it is your stakeholders, the people who buy your goods, the people who work in your organization, your clients. What are the things that would be important for them, and to find a relevant, let's say, a risk as well as an opportunity, I think makes good business sense. Then if we go on to the ED, the general disclosures, coming back to disclose all, I've underlined it, all significant risks and opportunities. So if we go back to the previous slide, have we considered everything? Which of those are significant for our business? Which of those do our stakeholders care? Which of those can we make an impact? Which of those have an alignment? Obviously, if the world stop reading, and if literacy levels go down for a publishing house, there's a risk in that people won't be buying our books. So again, there's an alignment. Then also, initially in the ED, they talked about defining materiality in the context of enterprise value. But you know, they received a lot of feedback on that, and I think a lot of people were worried about confusion. What if we have materiality for preparation of financial statements as defined in IAS 1 and IAS 8 and the practice statement? And now we have a different concept of materiality for sustainability. And therefore, I know one of the things that have changed from the ED and will be in the final IFRS S1 is they've removed that concept of materiality linked to enterprise value, and they use the same materiality as we use for IFRS accounting standards. Kevin, and I know you earlier this morning when we discussed it, made the comment that these sustainability standards, when you look at them, they look, they feel, they smell like an accounting standard. And maybe that's why CFOs and finance team actually get their heads around it very easily. And there's been a deliberate attempt by the ISSB to keep the terminology consistent with what we see in IFRS accounting standards.
And that's right, Aletta. I think I've been holding on to this concept somewhat in my journey towards these standards, because at the end of the day, we can talk governance and sustainability risk, which really might happen at the board level or above, or the C-suite level and so forth. But at the end of the day, what this standard is about is translating this into financial reporting for capital market investors. And if we start to change the underlying concepts on what those are, it's never really going to fit. So this development that we're talking about today is an indication that the board setters understand that. And at the end of the day, the finance teams and the CFOs who will be translating what's happening at the governance level down to investor communications can relate it back to a core concept that has been developed over decades. This is not, you know, going to be that new. So yeah, that to me makes me happy on one level, and it also helps with a starting point for our listeners who are actually in the finance part of the business and going to be required to actually put this all together.
Correct. And then they also talk about, so they define enterprise value, but they also look at sustainability disclosures must be made available at the same time as financial statements. You know, in order to get to compliance for IFRS sustainability disclosure standards. I know there's been a bit of debate on this, in particular in Australia. And maybe it's a good time to just clarify. Once the ISSB issue IFRS S1 and S2, which they say will be June this year, then we need a process where those standards, similar to IFRS accounting standards, have to be considered by the ISSB. Consider the potential impact and relevance application to Australian entities. Now we know Treasury's already indicated that this is what they will follow and consider and push out. Whether there'll be slight changes, don't know. But one of the things I know that was discussed in that Treasury proposal is, can we really mandate that the sustainability disclosures have to be provided at the same time as the financial statements? Could it maybe be a little bit later? And the thinking was, we know in Australia we've got such staff shortages, and finance teams and CFOs are under so much pressure to get financial reports finalized, audited within a short time frame. You know, to add more disclosures, and this is not just little disclosures, this is extensive disclosures. To add this on top of that existing workload, you know, is it achievable? However, when I speak to CFOs and finance teams and ask them about that, and you might have views, please let me know. They say, Aletta, you know, we don't have a quiet time anymore. In a way, we would like to do it, get it out, get it done. Because after we finished our financial statements, we roll into the next thing, and we roll into budgets, and we roll into half year, in a way, you know, to you know, keep it together. So we've got the same system, process, review process, etc., discussion with board. So not sure how that one's going to play out, but at a global level, they would like it to be at the same time. Now, the general sustainability related disclosures use a similar concept that we've seen in the TCFD recommendations. So remember, TCFD recommendations are looking at climate change, and here, even at a top level, general requirements that go back to, you have to look at your governance, you have to look at strategy, you have to look at risk management, and then you finally look at metrics and targets. So it's a similar approach. We expect to see this approach across all standards, so S3 onwards, that this will be the starting point, whether it's biodiversity, deforestation, human capital, etc. This will be the approach. And then they also have a bit of an overview in the snapshot where they explain again, so what do we mean by governance? Information to enable the investors to understand the governance processes. And then they talk about strategy, risk management, metrics, and targets. Kevin, you made an important point, and that is these IFRS standards, IFRS S1 and 2, are looking at the primary users of general purpose financial statements. So they're looking predominantly at equity investors and debt financiers. That is their key target, because remember, that is also the target audience of the financial statements, the primary users of financial statements. And if we want to have a link, we need to have the same users in mind, and that's why you see that terminology as well. So important to consider, if we've got all these risks, if we've got all these opportunities, and we've assessed what is important to broader stakeholders, but to understand how will it ultimately impact the financial statements, because as soon as it impacts the financial statements, the numbers in the financial statements, those primary users will care about it. So there's a very specific link. I wanted to show you what I mean with it reads like an accounting standard, but I also want to show you that we now see a new word. When we looked at TCFD recommendations, it's soft and nice and gentle, and it recommends. When you get to IFRS S1, it's introducing a word that accountants are familiar with, and that is shall. So if you look at governance, the objective on governance is to enable users of general purpose financial reports to understand governance processes, controls, procedures used to monitor and manage sustainability related risks and opportunities. And then they go further and they say, to achieve this objective, an entity shall disclose the following. So these are not optional extras. Specifically, an entity shall disclose. And from a governance perspective, these are all the things that shall be disclosed. The identity of the body or individual within a body responsible for oversight of sustainability related risks and opportunities. So very specific, who's looking out for it? So this is not saying, you can't say, hang on, we have nobody looking at it. I mean, you need somebody that's looking at it. Even if you ultimately assess none of this is relevant, and that would be very hard to believe, but even if you get to a position, none of this is relevant, who made that assessment? Who continues to consider whether it changes? And then in the second one, how the body's responsibilities are reflected in the terms of reference, board mandates, and other related policies. So you can't say, I've got somebody looking at, how are they looking at, what's the terms of reference? How that body ensures appropriate skills and competencies are available. So do we have the right people doing this? Also, how and how often this body or its committees are informed about sustainability related risks and opportunities. I think I've previously told you, when we looked at sustainability and a sustainability report for BDO Australia, our inaugural report, I was reporting to our chief executive partner on a 2-weekly basis and reporting to the board monthly for a period of time until it's approved, and then maybe a bit less now that we're going and looking at other stuff, and there's more time for us to develop stuff and go back to the board. But you could see there was quite rigorous reporting obligations. How the how the body and its committees consider these risks when overseeing the entity's strategy. So it's saying, hang on, you're looking at this, how do you factor it into strategy? So really important. So at BDO, for example, our chief strategy officer is part of our governance structure around sustainability. She is a member of our steering committee for sustainability because we acknowledge that strategy is really important and forming that risk. Then how the body and its committee oversee the setting of targets. So, you know, our board very consistently and carefully asked, you know, if you want to set these targets, how did you do it? Can we achieve it? Very concerned that we're not greenwashing, very concerned that we're doing the right thing and only disclosing, you know, so they're asking tough questions, which is what the board should be doing. And then a description of management's role in assessing and managing sustainability. So a lot of questions around oversight, board or the board's committees, but also management. What's your role? How do you do it? And disclose all of that. So there's a lot of disclosures here. So you have to put all of this in place in order to be able to disclose it. So the shall comes in. Then even if you look at strategy, so objective is to enable users to understand an entity's strategy for addressing these. Remember that link between sustainability and strategy. And to achieve this, you shall disclose the following information. The significant risks and opportunity that is reasonably expects that could affect the business model, the strategy, cash flows, its access to finance, its cost of capital over the short, medium, and long term. The effects of significant risk and opportunities on his business model, on his value chain, very important, its value chain. The effects on its strategy and decision making, etc. So you can have a look at this. So the next one, the effects on the financial position, financial performance, cash flows, and distinguishing between short-term, medium-term, long-term. Also the resilience of its strategy. So, you know, we've got a strategy in place. This is what we're doing. We see all these risks. This strategy that we currently have in place, can it deal with these risks if they eventuate? So that resilience have to be considered and disclosed. Then if we go on to risk management, I think you would be somewhat familiar with this because a lot of organizations have amazing risk management in place and already do disclosures of risk management around financial instruments, IFRS 7, for example, etc. But again, the entity shall disclose the process or processes it uses to identify these sustainability related risks and opportunities. They shall disclose the process or processes to identify the sustainability related risk and risk management procedures, and it will include the following: how you assess, so the likelihood, how do you prioritize, how do you look at input parameters, your data sources, and whether you've changed your processes used compared to what you've done in previous years. So we've had a risk management assessment and a tool, and how did we update that to factor in sustainability? You know, so how do we identify, assess, prioritize these opportunities? Again, how do we monitor and manage it? So we've got all this risk appetite, we've got a risk register. What controls do we have in place? How do we manage it? How do we monitor it? So a number of shall disclosures. Another one around metrics and targets. Now, this is where it really gets, the rubber really hits the road. This is where we get to that scope 1, 2, and 3, amongst other things. So an entity shall disclose the metrics it uses to manage and monitor these risks and opportunities, and the metrics it uses to measure performance, including progress towards targets. So a lot of the examples that we've seen, everybody has, maybe it's a bar, maybe it's 5 stars, and on this particular one, we've 3 stars, or we've just started. Everybody's trying to indicate to what extent we're working and are currently achieving towards these goals and these targets. when a metric has been developed by an entity, you shall disclose how the metric is defined, including whether it's an absolute measure or expressed in relation to another metric, whether the measurement of the metric is validated by an external body. Again, we want credible information, explanations of the methods that we use to calculate these targets and the inputs to the calculation, including significant assumptions made and the limitations of those methods. You know how we currently in note 1 often, or note 2, we disclose significant judgments and estimates that we make to prepare financial statements, and often those are flagged in key audit matters in the audit report. We have a similar disclosure here. We have to explain the methods we've used, and we have to provide the inputs in the calculations. We have to disclose the assumptions, so very similar. And then also, an entity shall disclose the targets, the metric they use, the period over which it applies, the base period, any milestones, interim targets, your performance against it, your revisions to targets. You can't just change it. If you revise it, you have to disclose why, how you redefine it, and you know, explain the change, etc. So metrics and targets, there's a number of shall disclosures. So it's not just saying we're going to reduce our carbon footprint by 50% by 2030. How are you going to do that? How are you tracking against it? You know, is it achievable? Detailed disclosure. The other concept that comes through IFRS S1 very clearly is connected information. We need to provide information that enables an assessment of connections between different sustainability-related risks and opportunities. But secondly, disclose how these sustainability-related financial information is related to the information in the financial statements. So the link between the various risks and opportunities, but also the link to the financial statements. And then fair presentation, and we are familiar with the concept fair presentation or representation in accounting standards, a similar concept. And here they're talking, and they've said you should consider, and I think they're softening the word. Initially, the ED said you shall consider the following standards in an order, so similar to the hierarchy in IAS 8, in which we consider different standards in order to come up with an accounting policy. They've softened the word shall, and they now say you are permitted to consider certain of these, but it's not a requirement anymore. So we're waiting for the final standard, but that's a feedback that I've seen in the agenda decision. So it's, yes, we've got IFRS S1. It's not dealing with all topics. So in the interim, consider what the European Union is doing. Consider the ISSB standards for industries, etc. So again, just a bit of a visual. You identify all your sustainability related topics for disclosure. If there's a mandatory IFRS, for example, IFRS S2, you apply it. If not, you consider all these other standards issued by other regulators that are in the process of being converted into an IFRS, and that is a reasonable starting point. They also talk about, you know, you have to look at information in relation to your value chain. So it's risk and opportunities across your value chain. What does that mean? It means supply, it means marketing, it means distribution channels. It means materials and service resourcing, products and services that you sell and deliver. It means financing and regulatory environment in which a company operates. It looks at human resources. So value chain is not just your organization as an island, but the whole value chain. There are a few general features that we often see in accounting standards, you know, around comparative information to be provided, how frequent do we report, the location of the information, so in the OFR, in a financial report, when do we have an error that we have to restate, and when is it a change in an estimate, and when can we have a statement of compliance. And this is an example that's saying, listen, if I use the information available last year to come up with a disclosure, and new information become available during the current year, that it's not an error, that is an update to an estimate. And yes, you have to update your estimate, and you even have to do it in your comparative information, but it's not an error. So this is an example from the ED to explain that. The other thing that I'll just flag, because I know we've run out of time, is the ISSB met in Montreal in February, and there were a lot of discussions around proportionality or scalability, so that these standards are not just appropriate and applicable for the big end of town, but how would this be proportional or scalable to SMEs? And there's a few quotes in here. The following 3 ways can lead to a balanced approach in sustainability reporting. So there should be proportionality or scalability, comparing cost and effort, cost benefit, a phasing approach, and that's what we've seen in Australia, that there could be certain transition reliefs. The ISSB is thinking potentially in year 1, you don't have to do scope 3 disclosures in year 1, and potentially in 1, no comparatives. And then also there's a need for capacity building within finance teams, within assurance providers. So that's important. And some of the things they were thinking about, and again, this is one of the quotes that we received after this conference in Montreal. For smaller companies, the focus will be looking at core data, targets, understanding the context and the governance around it, looking at the guidance out there, learning from others, building on the data when standards emerge, and the expectation that there'll be more comparable data over time. So this is just saying we're looking for continuous improvement. I've included some diagrams from Montreal on how they're trying to scale or phase in the requirements. And, you know, so what are some of the mechanisms they're trying to use that give you an idea of where we could expect to see some transitional relief, potentially around scope 3. And they've also flagged where they think they need additional educational material. So there's a few diagrams. There was also a sustainability symposium held in Montreal, more or less at the same time as the ISSB meeting. And they came away afterwards with 7 key takeaways from the conference. So first, you know, the ISSB standards are nearing issuance, yes. The SASB standards, which are focused on industries, a practical tool to implement S1 and S2, and it will be in the appendix as well of S2. Global comparability remains paramount if you want to do capital raising, debt financing. We know jurisdictions are actively considering these ISSB standards that are about to be issued. We know Australian government and Treasury put out a consultation paper. Again, capacity building is critical. And, you know, the work to advance integrated reporting is underway. So the 2 sibling organizations are actively trying to work together to get to integrated reporting. And then many stakeholders have enabled the ISSB to make this significant progress. So standard setting bodies that have done a lot of work over many years are now part of the ISSB, working with the ISSB to come up with one set of standards, which is amazing. The ISSB, as I said earlier, they've decided that they will say that they permit, but you don't require, to look at the most recent pronouncements of other bodies. So you can look at it, but it's not a requirement. And also, you know, you permit, but you're not required to look at the GRI standards. So again, we don't want to prevent people from doing this. So you're permitted to do it, but it's not a requirement because that might be too onerous, especially in earlier years. They also talked about effective date for periods beginning on or after 1 January 2024. And we know that Treasury is thinking about a similar date for Australia. And then also talking that in that initial year, potentially, you know, there will be some relief from the requirement to have the sustainability information at the same time as financial statements. So you could put it at the same time, but potentially a bit of relief. Again, there might be some relief around your scope 1, 2, and 3 measurement, because not all entities are ready to apply the greenhouse gas emissions, the greenhouse gas protocol, so there might be relief there. And then also relief from the requirement to disclose scope 3 initially. So you can see this has been tentatively decided by the ISSB, but we're waiting for the final standard to confirm. And again, at the March meeting, they were saying, what are our next projects now that IFRS S1 and S2 are complete? And they're working on biodiversity, ecosystems, ecosystem services, and very interestingly, human capital and human rights. And we know in Australia, we already have modern slavery statements for entities, revenue with more than 100 million, so it's at the big end of town again. And again, they talked about, we know, sorry, just go back. Also, we know that there's a connectivity project with the ISSB. How do we get to integrated reporting? And that's a focus for the ISSB and the ISSB. They've also shared some information on how the ISSB is looking at the SASB standards, the industry-based standards. Because it will be in the appendix, it's really important that they have a look at that and make sure that it's appropriate. So making good progress on that. Finally, some next steps, and I think this is important. The key takeaways for me from a recent 3-part ISSB webinar series are the following 5 things. First of all, there's a challenge of implementation of scope 3 emission disclosures. It absolutely is a challenge. Estimates are acceptable way to begin, but then you have to support it by explainable assumptions. So that's absolutely a challenge, and in yellow I've explained it a bit further. For smaller and medium-sized organization, transition are made pragmatic and scalable by providing guidance, educational material, and working together with different jurisdictions, and they provide transitional reliefs. So they are aware of the scalability and that they want to encourage smaller and medium-sized entities to also comply with these standards. They also flag the third one, the importance of connectivity or interoperability. So, it provides a robust 360-degree view of the corporate reporting of a company. It leads to better general purpose financial statements. And it poses a great opportunity in increased departmental collaboration, holistic understanding of company strategies. I think that's amazing. Number 4, the industry-based SASB standards are very useful for preparers and investors. It improves comparability, etc. And then in number 5, the companies just starting out on their sustainability journey, start with the TCFD framework and the SASB standards, identify gaps, develop your processes and controls, and to look at this as a value creation exercise instead of a compliance exercise. I've put in the links to the YouTube channel where you can look at these 3 ISSB webinars, but our 5 key takeaways from those webinars. I know I've gone over time, a full 9 minutes, so if you need assistance, we've got corporate reporting insights being published tomorrow. We've got sustainability insights, and we've got corporate reporting leaders that can assist you, as well as our broader team, and also a national sustainability and ESG team. I would like to say thank you very much for joining me today. This was really a mouthful. And as you can see, it's not only a mouthful, there's work to be done. There's important measures to be put in place as soon as possible. And we'll continue to revisit these topics as we learn more from the standard setters, look at the final standard, and happy to have conversations with you. Kevin, thank you very much, and I hope you all have a great day.
Goodbye, everybody.